there is still a lot of confidence in the market, and there is still a lot of liquidity in the market. Occasionally concerned that there will be some event, a so-called black swan, that none of us have interpreted, and that will cause a crisis in confidence and a liquidity squeeze. The biggest black swan out there that scares me is
It's my great pleasure to welcome back Rick Rule, co-founder of Battle Bank, former CEO of Spot US, legendary resource investor. Everybody in the resource space knows him. Rick, welcome back.
David. It's a pleasure. I've been watching the ascent of the popularity of David Lynn's online empire for a long time with great pleasure. You deserve all your success.
I appreciated it. Any growth that we've had is because of good guests like yourself. People come to watch what you have to say, not me. So I appreciate you being here. Rick, let's talk about a lot of viewer questions came in when I asked people what I should ask you today. You're a very interesting person, very popular. So we have a few questions to the economy, which I'd like to start with first, and then I like to talk about the commodities, copper, uranium, gold, a lot of questions about gold. Starting with this one, are we heading into a global depression? In parentheses, we are already in a recession. This particular user by the name of, oh, it's a YouTube name. I can't even pronounce it. It's a string of letters. I'll put it on the screen. He's making the assumption, he or she is making the assumption we're already in a recession. Are we heading into a global depression? Let's start with that.
I think in terms of conventional semantics, we aren't yet in a recession. We are in an economy that is working well for people like me, people with access to subsidized credit, and people with the knowledge to use that credit. It is not a society that is working well for people who sell their sweat. Uh, it is also an economy where I think, and we can talk about this later, we are beginning to cannibalize to a fairly substantial extent the capital available for people your age in favor of people my age. People my age voted themselves all kinds of cool benefits and forgot to pay for them. And I think the chickens are coming home to roost around that. I I need to say, David, that through most of my career, I've been a bit pessimistic about the economy. I joke that between Doug Casey and I, we have accurately forecast 17 of the last three recessions. And so I don't listen to myself as much anymore. But I do also need to say that I'm concerned about the fact that the economy that we are in has been propped up by government spending and
Yes.
by very cheap subsidized credit for a long time. In my experience, I'm tempted to say that there needs to be a reckoning. That reckoning may very well be in the form of a recession or a depression. I also need to say, however, David, that by training I'm a credit analyst, not an economist. That my track record on economic forecasting is, like all other forecasters, lousy.
This is an interesting chart. I like to show with you, or share with you rather, a chart on copper. People have talked about copper being Dr. Copper, potentially a leading indicator for the economy. I'd like to get your take. So this is what is going on right now with the prices. You know, it broke new all-time highs earlier this year. Subsequently, it's fallen down to about, well, it's currently $4.16 a pound. It was at above five. Interestingly, if I were to overlay this with the S&P 500, I don't know if many people are aware of this, but I'll show it anyway. Um, you can see a not too far relationship. Let me show this with the Nasdaq as well. Uh, if you overlay these two charts together, over the period of a year, there does seem to be some sort of relationship, movement in the same direction, albeit not at the same time. Copper seems to have indeed actually led movements in the Nasdaq. The Nasdaq is a purple line here.
Right.
What is your reaction to this chart?
Well, it's an interesting chart, and I think there's a whole bunch of ways to read it. I am not a technical analyst, but
Mhm.
it does seem that moves in the copper price, as demonstrated by this chart, presage moves in the broader equities market.
Yes.
If that's true, that would reinforce the suspicion that economists have that copper is a wonderful leading indicator for the economy. I'm going to beg off asking your listeners to pay too much attention to my interpretation of the chart, given the fact that I'm not a technical analyst. I would like to point out, however, something unstated with regards to the chart, which is to say that both numbers measure the index prices or the copper price in nominal as opposed to real dollars. If
Yes.
you adjusted that pricing for the deterioration in the purchasing power of the dollar, then the chart becomes, I think, substantially more dramatic. And it's something that I would increasingly encourage your listeners to do, which is to say, question the validity of data that hasn't been altered to reflect real as opposed to nominal pricing levels.
Let's take a moment now to talk about one of the most exciting commodity bull markets in recent years. Gold is soaring, and the copper price climbed to new all-time highs earlier in the year. Today's sponsor, American Pacific Mining, is seizing the moment by partnering with world-class miners to unlock America's next big copper-gold strike. The company is fully funded with a $14 million exploration blitz this summer and is nominated for multiple industry awards, including 6 by S&P Global. American Pacific Mining is trading on the Canadian Securities Exchange under the ticker symbol USGD and in the US on the OTCQX under the ticker USGDF. Click on the link down below or scan the QR code here to learn more about this company. I would like to come back to copper and other base metals when we talk about the commodities portion of our interview today. I want to talk about this debt, this concept of rising debt that you alluded to earlier, Rick. As you're aware, the nation's debt, the U.S., I'm talking about, recently surpassed $35 trillion. This Congressional Budget Office, CBO, is projecting not only the debt, but also the deficit to continue to widen into the next decade. Rick, to what extent is this going to be inflationary?
I think it's going to be very inflationary, David. I'm old enough to remember the decade of the 1970s when we had the same sort of circumstance in front of us. It's important to note that at the beginning of the decade of the 1970s, the on-balance sheet liabilities of the U.S. government were less than 20% of GDP. Now the on-balance sheet liabilities of the U.S. government exceed 115% of GDP. What that means is there's less capacity to deal with it. But let's look at the numbers, which are truly enormous. As you suggest, the on-balance sheet liabilities of the U.S. government, represented by U.S. treasuries, are about $35 trillion, or $29 trillion net of the Fed's own balance sheet. The scarier number is the net present value of the off-balance sheet liabilities of the government, which is to say entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that sort of thing. The Congressional Budget Office, not some cranky old libertarian named Rick Rule, but the Congressional Budget Office estimates that those numbers currently exceed $100 trillion. It would seem for both parties in the United States that continued spending is sacrosanct. If you can't contain government spending, the only way out of funding these twin deficits that I can see is by printing. Uh, People say it isn't a problem, first of all, because we owe the money to ourselves. Wrong. The spenders owe it to the savers in terms of the on-balance sheet liabilities. But the off-balance sheet liabilities at $100 trillion are simply actuarially unsound. In the U.S., when Social Security was instituted, it was designed, well, it was designed to start at age 65 when the average life expectancy of an American male was 66. In other words, society took on for men a 1 year liability, for women a 6 year liability. Now it starts as young as 62. There's a disability feature, and the life expectancies are much, much greater at the same time that the population of old people, beneficiaries, dwarfs the population of young people, contributors. This is really an intergenerational transfer of wealth from your generation to my generation. So, to begin with, thank you. But the truth is that it cannot actuarially continue. I think that really the only way out will be to print. They say, as an example in my country, well, tax the billionaires. The total net worth of American billionaires is $5.6 trillion. If you stole all of their money, every bit of it, you would fund the operating deficit, which is to say the on balance sheet liability deficit, for 2 years. You wouldn't make a debt in principle, and you wouldn't do anything at all for Medicaid, Medicare, Social Security, federal pensions, and military pensions. This is a spending problem, not a revenue problem. And I think it's going to be a very, very, very large political problem. And I think the outlook as a consequence of that arithmetic for the US dollar and every other fiat currency on the planet is pretty dire. Not an immediate problem, not a 2024 problem, not a 2025 problem. As I recall, the decade of the 1970s, we solved the problem by reducing the purchasing power of the US dollar by 85% over the decade. In other words, we inflated away the net present value of those obligations. And the only way that I, as a credit analyst, see our doing that, doing that, which is to say, reducing the economic impact of that deficit and maintaining nominally our promises, would be to do the same thing, reduce the purchasing power of the dollar, and hence reduce the net impact of those promises on society.
This is a follow up to this. What an interesting question. How long until we see prosperity? Pretty loaded question. I'm not sure how you would interpret that, but I'll let you take a stab at this.
Well, it depends on for whom. For David Lynn, who is building a personal brand and can charge for the knowledge that he brings to an audience, times have never been better. Prosperity is here. For Rick Rule, who has access to credit and the knowledge of how to use that credit on assets that generate income in excess of the cost of capital, this is the finest time in human history. There's nothing like it. For the people in Argentina very recently who had the foresight and the courage to cut government expenditures by 50% and cut regulation, prosperity is coming back in leaps and bounds. For people who live in heavily indebted societies, for people who have believed the government lies around their entitlement to government benefits and haven't developed the skill sets to participate in this economy, I don't think that prosperity will ever return.
Is there anything they can do about that?
Invest in themselves, invest in their education, come to understand that the expectation of entitlement on the backs of others is fraud, and that they need individually to develop the skill sets that will allow them to generate enough utility for other people that it exceeds the utility that they consume for themselves. That's the only way out. There's a young man who occasionally does some work for me around here, 23 years of age, and he bought himself a power washer. And with this power washer, he is able to make himself $150,000 a year. He, at 23 years of age, with his fiance, owns a home, and they are saving to buy a second revenue property. He generates $150,000 a year in gross sales. His fiance generates another $65,000 or $75,000 in gross income, and their gross consumption between the two of them is $60,000, which is to say they're generating $200,000 pre-tax with high school educations while spending 60 and putting the rest in income generating or at least cost avoiding real estate. For them, prosperity is here.
This should be a model for all the young people out there who are in debt and don't know what to do with their lives. Get out there, get a power washer, get to work, so to
Indeed.
speak, metaphorically speaking. All right. Rick, we talked about inflation. By the way, recent inflation numbers have cooled down somewhat. 2.9% was the latest reading that came in yesterday on Wednesday, the 14th of August. It seems to me that the Federal Reserve is perhaps locked and loaded, ready to cut by September. Do you have any view that is um, that deviates from the consensus view that a cut is coming by
I think
September?
I think a cut is coming. I think a cut is irresponsible, but I think a cut is coming. The lower level employees at the Federal Reserve, at least the ones I'm in contact with, believe that the Federal Reserve is the only institution that is in the way of the rapid deterioration of the US dollar, which is what a cut would do. I want to take some issue with the beginning part of your statement, which is to say that inflation is moderating. Remember that the measure of inflation that they use is the Consumer Price Index, the CPI. The US federal government would have you believe, as an example, that health insurance costs have declined by 21% over the last year. I don't know anyone who got a rebate, David. Um, and importantly, in both the US and Canada, and I hate to make this so statistical, we're probably boring the hell out of your listeners, but the CPI doesn't include tax. The largest component of a household expense, a working household expense in the United States and Canada, is tax. It's the cost of government. And the idea that a cost of living index doesn't include the cost of tax is farcical. It's completely farcical. For middle income families in the United States and Canada, the cost of government exceeds the cost of shelter, exceeds the cost of healthcare, exceeds the cost of energy, and exceeds the cost of fuel combined. And it's not in the index. So when people look at inflation statistics, I would ask them to look behind the numbers. And I would ask them to think about the deterioration in the purchasing power of US and Canadian dollars relative to the basket of goods and services that they consume, and not pay so much attention to the CPI, which I now refer to as the CPI.
I've heard that one before. Okay, Rick, before we move on to the commodities, I want to get your general sense of how markets are positioned right now in investor sentiment. So, notwithstanding the correction that we had last Monday, which shocked people globally, Asian markets, Korea, for example, Japan had its worst day in the Nikkei since 1987. A lot of that has rebounded, of course. And today we're seeing gold at 24.95. We're seeing the S&P 500 back up 1.3%. Bitcoin crypto assets are rebounding as well. This is an interesting chart. Let me just present this to you here. This is from the Financial Times. U.S. loan funds post biggest weekly outflow since March 2020. So investors pulled $2.5 billion out of funds that invest in junk or leveraged loans during the week of August 7th. So people are pulling out of low grade credit, but risk assets like stocks continue to go up. Crypto assets are doing okay, not great, but okay. And it just shows that even though risk appetite still remains strong, outside of that sphere, credit markets are potentially seeing some cracks. Anyway, I'm just presenting you
Yep.
some facts here. How are you interpreting sentiment overall right now?
There is still a lot of confidence in the market, and there is still a lot of liquidity in the market. There's a lot of cash in the market. As you know, David, I'm occasionally concerned that there will be some event, a so-called black swan, that none of us have interpreted, uh, and that will cause a crisis in confidence and a liquidity squeeze. We aren't seeing that. I think, by the way, parenthetically, that the disintermediation in high yield debt funds is highly intelligent. I think that we have underemphasized credit quality in a search for yield. And I think what you may be seeing is at least smart households returning to some sense of sanity. The biggest black swan out there that scares me is the trillions of dollars in high yield ETFs, where the top structure, the ETF itself, is highly liquid, but the assets that they hold, junk bonds, often over the counter bonds, are highly illiquid. If you have a circumstance where nervousness about credit quality comes down to the retail investor and they begin to liquidate the ETFs, and the ETF managers are forced to liquidate junk bonds into very illiquid markets, you have a run on the bank that almost can't be contained. There was a saying in junk bond markets in the 70s when they were very skinny that many of these bonds were, David, quote, owl bonds. An owl bond is where you call your broker and say sell, and your broker says, to who? To who? And that's my real terror. My real terror is that concern about credit quality becomes commonplace, and you have a disconnect between people coming out of the liquid ETFs and the manager's ability to sell the underlying assets. So I'm delighted to see people beginning to come out of those high yield ETFs now. If they did it gradually and ratably over time, we could perhaps sidestep my biggest single concern about the market.
Well, suppose money comes out of those ETFs. Where does that money flow into? What is a logical next step in capital flows?
Well, what I hope people are doing is putting it in shorter term obligations, maybe U.S. 10-year treasuries accepting 4.4 with effectively no credit risk other than the deterioration of the purchasing power of the dollar,
Yes.
relative to 7 in assets that I think are highly susceptible to default. Hopefully, people are taking shorter duration, taking less yield, and improving the credit quality of their savings. I don't know that that's what's happening, but I hope
Uh,
for their sake that's what's happening.
I want to present to you this chart. This may support, I guess, your black swan thesis. This is the Bloomberg United States Government Liquidity Index. I'll just read what it represents here. This index is a measure of prevailing liquidity conditions in the treasury market. When liquidity conditions are favorable, the average yield error is small. Under stressed liquidity conditions, dislocations from fair value result in an increased average yield error. Courtesy of Bianco Research, we're at seemingly a multi-decade high. Um, so again, liquidity conditions are deteriorating according to the treasury markets. Are you seeing that play out in the markets right now? Is that being valued? Is that being fairly priced?
Well, it depends on fairly priced.
Yeah.
I would suggest to you that the real deterioration in U.S. dollar purchasing power is more like 7% than the 2.6% suggested by the CPI. If my number is right, the U.S. 10-year Treasury paying 4.2, 4.3 has a negative real yield, and any liquidity is excess liquidity. But I'm being perhaps too arcane as a credit analyst. I am not seeing any evidence of illiquidity in the broad market. The buoyancy in the S&P 500 funds, the buoyancy of the QQQ, the technology index, I still see a market where institutional and individual confidence is high, perhaps not as high as 2 years ago, but certainly compared to other periods of time when there were liquidity squeezes, both confidence and liquidity in markets seems to be very high. People who are investors, people who are speculators in junior resource equities may suggest that the liquidity isn't there. But I would suggest that even there, in the best issues, not the lame, the halt, and the blind, but the best issues, the private placements are uniformly oversubscribed and uniformly oversubscribed without warrants. If you look back over the 50 years that I've been in this market, I would describe this as a liquid rather than an illiquid market.
Let's talk about commodities now. So you mentioned that sentiment for risk assets is still relatively strong. Can you apply the same statement to the mining stocks, both senior and perhaps junior?
No, I mean, I suggest that for 75 or 80% of the junior issuers, they have no value. So if they have a bid, that bid is excessive. But in the quality end of the market, which is to say what investors are willing to pay for names like BHP, Rio, Glencore, even Tech, relative to the incentive price necessary to produce the commodities that humankind needs to maintain its material standard of living, those stocks are too cheap. There is illiquidity there at the top end of the market.
Let me show you this. So this is the GDX, as you know, large cap
Yep,
ETF versus gold. So gold is the purple line here. Gold is up 19% year to date. The GDX is up 20
yep.
over the course of the last 12 years. Sorry, 12 months rather, 1 year. Similar performance as well, 29% up for both the GDX and gold. Some might argue this is normal. They're both going up, moving in the same direction. However, another argument is, well, what's the point in investing in the miners if I'm not getting a better performance in gold? I want that leverage, which isn't there. So, why is that leverage not there over the last year?
A very important question. The first is that while the gold price has gone up, which would lead people to expect broader margins, the cost of producing gold has gone up a lot. Labor costs have gone up, cement prices have gone up, steel prices have gone up, energy prices have gone up. But in particular, on a global basis, the social take, taxes, royalties, offsite capital contributions by the industry has gone up too. And so the margins that people had expected to get, the operating margins that people had expected to get as a consequence of higher gold prices, have disappointed people. They haven't come through. On the more cost efficient issuers, the Agnico Eagles of the world, as an example, the margin increases have been there and the markets have rewarded them. But the more marginal producers have not seen the margin increases that people would expect. The second thing, I think, is that the institutional investor has become quite disenchanted with the gold trade, the gold equities trade. I think that stems back to the decade 2000 to 2010, where the gold price increased from, let's call it $250 to, let's call it $1,700, a 6 or 7 fold increase in the gold price. And the free cash flow per share on the XAU fell. It took real skill to generate declining free cash flows per share when the selling price of your commodity increased sixfold. Now, I would argue that the industry is structurally different now than then, and the expectation of the few remaining institutional investors is much harsher now. So my suspicion is that if the gold price continues to trend higher, that you will begin to see those operating margins, but you haven't seen them yet. I think the third thing, David, is that the increase that we saw in gold prices until about 25 weeks ago was led by foreign central bank buying. And those buyers don't buy gold shares. So it would make perfect sense that if the leader, if the buyer, if the liquidity that drove the gold price higher was central banks, and they don't buy gold shares, that the gold shares wouldn't have the same bid that gold had. Western retail investors, measured by inflows and outflows from physical ETFs, only became buyers of gold 20 weeks ago. Until then, they had been continuous sellers for 2 years. And that's the natural market for the gold equities. So I would suggest that the gold equities bid was gone while the gold bid was present, which explains the discontinuity in pricing until 20 weeks ago.
And by the way, if we compare the large caps to the small caps, this chart shows the GDX versus the GDXJ. The GDXJ is the bar chart. The GDX is the purple line. Over
Yep.
the course of the last, year to date, they're up about, the GDX is slightly outperforming at 22% versus 18%. Over the last year, about the same, 32 versus 29. Interesting how in a bull market, the large caps are slightly outperforming the juniors. You would expect the juniors to have higher beta. Doesn't seem to be the case this year. Why not?
I think historically what you see is what you have seen, which is to say gold bull markets are usually led by the physical. They're led by
Okay.
the bullion. The second to move are the large companies, which benefit directly from an increase in the bullion price. Later stages of a bull market, you will see the smaller companies begin to outperform the bigger companies. Uh, Part of that is to be expected. The larger companies early in a bull market have higher share prices relative to asset values and a lower cost of capital. If the better of the smaller companies don't catch up, they get taken over, which is to say the market arbitrages away the valuation discounts. But what we're seeing in this market is consistent with what we've seen in precious metals and precious metals equities markets going back 50 years.
This is actually is a question from Grumpier by the Day. What's the M&A environment like? Good segue to what you just said. How does he see it evolving over the next 6 to 12 months?
I think the M&A market's very healthy now. The acquirers that you're seeing are largely strategic as opposed to tactical, which is to say that they're making acquisitions that fit in with their existing assets fairly well. I think it continues too, particularly if the equities prices don't match what we see as expanding margins, assuming that gold prices hold steady over 2 or 3 quarters. There's a great disparity in the market capitalizations of single asset producers relative to multi asset producers because single asset producers are seen as more risky. And if this disparity doesn't go away, I think you'll see the same kind of M&A that you saw in the period 2000 to 2010, which is to say that the market will arbitrage away the valuation differences by having the multi-asset producers take over the single asset producers. We have certainly seen the rise of passive investing in all financial spaces, but also in the gold space. And what that means is that the market needs to form entities that are large enough and liquid enough that they benefit from index buying, that they benefit from passive buying. And part of the M&A that we're going to see is more tactical. I think that's to come, which is to say that people merge simply to become bigger and more liquid so that they have access to index buying. In the US market, certainly the ability to generate index buying while at the same time maintaining an evergreen prospectus, an at the market prospectus, greatly lowers the cost of capital for aspiring producers. And I think that's going to be one of the things that shapes the M&A landscape going forward.
It has very little to do with sentiment in stock markets overall, Rick.
I think the sentiment in stock markets overall, gold does well during periods of fear, and we aren't in a period of fear yet. We're still in a period of greed. The interest in AI, as an example, generated larger gains in names like NVIDIA, individual names, than the entire gains of the gold sector. It's very important to note, David, that while gold is important to you and to me and to your audience, that the market share of gold and precious metals assets in the U.S. market is less than 1/2 of 1%, which is to say less than 1/2 of 1% of total savings and investment assets in the United States involve gold or gold-related securities. The interest in gold as a subset of equity markets is non-existent, which, by the way, I think is extremely healthy going forward. The 4-decade mean market share of precious metals and precious metals related assets was 2%. And if you experienced in these equity markets a return to mean, which is precisely what I think is going to happen, a return to the 4-decade mean, demand for precious metals and precious metals related equities in the US market would increase fourfold. You can imagine what that might do to price.
In our last part of our conversation, talk about AI and the impacts on the commodity space. Which commodities in particular do you think will benefit the most from this AI revolution, if you want to call it that? Before you answer that, I want to present you this chart here. This is silver overlaid with NVIDIA. I
Yep.
can overlay the same thing with copper or even gold to some extent. Pretty close relationship. I'm not saying silver is tracking NVIDIA or vice versa. I'm just saying there's a correlation. All right. As we know, there's no
Yep.
not necessarily causation. It
Yep.
seems to me that risk asset stocks, large tech stocks, have been moving in tandem with commodities, which is a very interesting phenomenon to me, at least. Anyway, I'll let you answer. I'll let you first address this chart and perhaps answer the broader question of how commodities will react to AI.
It would be difficult for me to understand why there would be a correlation between NVIDIA and silver. I believe that while silver is partly an industrial metal, that if you look at price charts going back 50 years,
Yeah,
the primary driver of the silver price has been investment demand. Uh, this chart presupposes that silver's utility in electronic fabrication means that it should correlate with NVIDIA. I think it probably correlates more with liquidity and speculative sentiment
probably.
in the
Yeah.
market. I think that what you will see if we continue to develop large data centers around AI and around storage will be an increasing utility of materials more directly correlated to electricity. Those would, of course, include copper, but I think 2 years out, they will begin to include nickel, which is in temporary oversupply. They probably will include lithium, which is currently hated. They will certainly include uranium uh, because you need increasing amounts of electricity, and society is demanding that that electricity generate less carbon. But to the extent that that electricity demand occurs in emerging and frontier markets, you will see continued strength in coal. It is the cheapest dispatchable source of baseload power in the world. That's going to make me very uncomfortable with woke US and Canadian investors. But, but the market share of fossil fuels relative to other kinds of energy materials is very high. David, that I like statistics. And I think I probably said this in an interview with you before. Uh, the commonly held view, the popular view, is that the future of energy supply is going to be alternative energies. It's worthy to note that we have now spent well in excess of $5 trillion on alternative sources of power, wind, solar, stuff like that. And we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. That is to say, a $5 trillion investment has reduced the market share of fossil fuels by 1% over 40 years. If electrical demand around AI and also electrical demand around the electrification of the poorer parts of the world that don't have access to electricity now continues at the current rate that's experiencing now, never mind an accelerated rate, demand for all forms of power is going to increase and increase fairly dramatically. And investors need to understand that when I say all kinds of power, that over 80% of power generation in the world right now comes from fossil fuels, and that will continue.
Well, let's just take copper, for example, as an example. I'm trying to make a point of
Yep.
supply versus demand and the
Yep.
potential deficit that's to come. Robert Friedland um, said that copper demand is going to surge to the extent that the next 20 years will see more demand than the last 10,000 years combined. Let's assume he's correct. I've talked to several miners in this space. They all say that it's more difficult to extract minerals today than it was 20, 30 years ago. The average lead time to getting a mine online is going to be longer. Permits are taking longer and so forth. So we may see actually a slower pace of production than times past. How is this deficit going to be, you know, met?
It isn't. Markets will have to work. Increasing copper price will lead to increasing substitution of other materials for copper and a reduction in our ability to meet the aspirations of humankind with regards to electrical distribution. The truth is that we needed to be investing in copper capacity 30 years ago, and there's simply no way in the next 10 years that we're going to be able to catch up. A couple statistics. 25 years ago, the median mine grade of a copper mine worldwide was 1.5% copper. Today, it's below 0.5% copper. We got to move a lot more rock to produce that copper. Second fact, social take, taxes, royalties, offsite capital contributions by companies of social expense is increasing at 7 or 8% compounded. It's becoming more expensive to produce copper. Fact, Permitting times are much, much, much longer. There's a wonderful copper deposit in the U.S. called Resolution, over 1 billion tons of 1.5% copper, 3 times the average mine grade worldwide, wonderfully located next to a copper mine. Freeways, power, water, skilled labor force. That mine has so far been 26 years in permitting. It's probably another 5 or 6 years in permitting. Then it needs to be built. This mine, over 1 billion tons of 1.5% copper, will not be contributing to the deficit for 10 years. And we're facing that around the world. There's no escaping it.
Final question for you. This is a question from can't even pronounce the name. Anyway, while Rick is a brilliant fundamentals investor, what systematic approach has he seen work in the resource space with indices, futures, or individual stocks? I think this leads to your service that you offer, which is to rank people's stocks. But people would like to know your methodology. I think is basically this question.
Yeah, indeed. What works the best for me is a contrarian strategy. I look for commodities where the current pricing in the industry isn't high enough to incent the industry to produce the amount of material necessary for the well-being of humankind. If you'll recall back to your interviews of me, David, with your former employer, 2021, the uranium price was $20 a pound. The average fully loaded production cost worldwide was $60 a pound. In order for the lights to continue to shine in places like the United States, the uranium price had to go up. Nobody wanted to be in the uranium trade because the price was too low. So a contrarian strategy is the only strategy I know that's consistently successful. The second thing that investors need to know, though, is the futility of employing short-term strategies around long-term themes. If you believe that the copper price is going up over 5 years, and you believe that there will be continued difficulties in permitting, you don't look for copper explorers. You don't look for copper juniors that won't have anything to produce. And you don't employ strategies that are 2 or 3 month strategies. You don't employ trading strategies around investing narratives. The contrarian narrative is a 3 or 4 year narrative. The copper cycle is a 6 or 7 year cycle. Many of your listeners, David, have trauma holding stock over a long weekend. They attempt to employ a 6 or 8 week strategy against a 5 or 6 year narrative. For those people, the biggest risk that they face is to the left of their right ear and to the right of their left ear. And then further, to the extent that people are really interested in what I have to say about natural resources, including their strategies, they can personalize it. If they go to ruleinvestmentmedia.com and list their natural resource stocks, I personally will rank them 1 to 10, 1 being best, 10 being worst. And by the way, I'll comment on individual issues if I think my comments have any value. But I would reiterate that the most important thing that people can do is invest in their own education and their own attitudes. What I've learned from grading over 80,000 portfolios in the last 8 years is, first of all, that most speculators own way too many stocks, way more stocks than they can follow. And that while they invest around long-term narrative, they employ trading strategies, short-term strategies. It's fine to be a trader if you are then actually a trader, trying to employ long-term trends against short-term strategies almost always ends in failure.
This is before we go. We know Rick loves to work, but on a personal note, does he have other hobbies or interests when banished from the office that he is willing to share, excluding personal investing, etc.?
I love to hike. Increasingly, I'm involved in online mentoring. I
Okay.
now have 1,200 students worldwide
Wow.
who subject themselves to my hectoring in online mentoring, which I get a lot of joy out of. My wife and I also like to travel. Now that's partially work related. I love to travel to see, as an example, mine sites, not just because I'm work focused, but I love to go to countries and have local people show me what they think is important, invite me into their homes, invite me into their lives, So I really, really, really like to travel. And while a lot of that travel is work related, I get to see the world in a way that a more conventional tourist would never get to see. And that's an endless delight to me.
You just ran a recently a very successful conference. It happens once a year, the Rick Rule Symposium. Coming up, you have a boot camp. Tell us about that.
August 24th, we have an online boot camp. Go to rulesymposiums.com. I need to mention, David, that our boot camps aren't entertainment products. We cover one topic in depth, usually about 8 hours. We have the recordings available for a year, and you're going to need to replay the recordings a couple times to get all the information that we give you in 8 hours. The upcoming one is about private placements, all aspects of private placements, how to structure them, how to avoid pitfalls, how to price them, how to do debt private placements as opposed to equity private placements. This boot camp will be of interest to semi-professional investors, accredited investors, people who have the legal access to private placements. And by the way, we'll talk about access to private placements, how to increase your deal flow, how to see private placements that often even your brokers don't see. But this is not a place for the casual speculator. This is not a place for the tourist. This is a place for the very, very, very applied speculator who is really willing to do the work to materially increase their net worth over the next 5 years.
That actually was the second part of the earlier question about M&A. How he sees the financing private placement environment. I'm assuming you have the same answer for the M&A answer.
I think the M&A answer will be different because I think the M&A answer is partially strategic, which is to say tucking in assets that complement existing assets, but it will become increasingly tactical, which is to say people will begin to want to get bigger simply for the sake of being bigger, so that they get increased volume, increased trading liquidity, and hence increased stock prices. Private placements is often about getting companies bulked up to the extent where they can either acquire or be acquired. It's for investors who are interested in a more definable, less market related, earlier stage opportunity. That's where the outsized rewards are. It's also where the outside risks are, outsized risks.
I could speak to you for hours, especially about M&A, Rick, but we'll end it here. If you'd like to learn more from Rick and actually spend a few hours with him, I encourage you to check out his website, go to his boot camp. We'll put the links in the description below. So make sure to check that out and follow Rick there. And I'll put the Twitter link as well for people who want to follow you on X, as it's now called. Thank you very much, Rick, for spending time with us today. I appreciate it. We'll see you next time.
Always a pleasure, David. I appreciate the work that you put into your interviews. It's a joy visiting with you and your audience.
Thank you very much. We'll speak soon, and thank you for watching. Don't forget to follow Rick below, and don't forget to like and subscribe.